Unlike the foreign exchange market, oil ignored yesterday's comments by Jerome Powell on the need to keep raising interest rates due to the obviously overheated labor market. Despite the Fed's tough rhetoric, oil prices extended gains, reaching $84 per barrel. And now the question arises as to what will happen next. More aggressive interest rate hikes in the United States will certainly put strong pressure on the oil market. However, Western countries' sanctions aimed at Russian energy and the oil products will further unbalance global energy markets. This, in turn, will lead to higher energy prices for end consumers. Even despite the decrease in Europe, prices are still significantly greater than they were a couple of years ago. Moreover, there are no signs of a decline. By and large, the same thing is happening in other regions. This naturally adds to the value and relevance of the energy products, thus contributing to a rise in the prices. Given that both factors are mixed in nature, they will somewhat cancel each other out. In this case, oil prices may become even more stable than quotes over other financial instruments. According to the trading chart, Brent crude oil futures recouped some of the early losses incurred during a downtrend. As a result, the benchmark rose above $84. The volume of long positions will increase further if the price consolidates above 48.50. Alternatively, the asset may resume its decline in case the price returns below the level of 80. Meanwhile, gold prices were wound down by Jerome Powell's statement. The yellow metal retreated from $1,880 per troy ounce, losing almost $10. However, its downtrend was short-lived. Gold futures have been trading sideways in the range of $1,860 and $1,885 for the second day in a row. And this movement can be seen as an accumulation process, which may result in new price swings. The best way to make a profit is to trade with a view to breaking through one of the boundaries of the sideways range. Obviously, the market needs a local correction, while Powell's statement has just put it off. According to the head of the central bank, US inflation is beginning to ease. In turn, inflation indicators have an impact on the Fed's monetary policy. If inflation eases, the regulator can soften interest rate hikes. However, Powell also noted that strong labor market reports could prompt the Fed to lift rates further. Now let's move on the ruble. On the one hand, the dollar advanced above 71 rubles following the overall mood in the foreign exchange market. However, in after-hours trading, the quotes fell to 68 rubles per dollar and the level seen 2 weeks ago. This indicates that the dollar's upside potential is exhausted. The Russian currency looks much more stable than other currencies and has fallen against the dollar much more modestly. From a technical point of view, this paves the way for further losses in the ruble. However, one should keep in mind that the ruble is far more dependent on political factors than any other currency in the world. It has recently been reported in the Western media that the sanctions imposed earlier are ineffective, and there are growing concerns that new tougher sanctions will not bear fruit as well. Such a shift in rhetoric supports the ruble, coupled with the ever-increasing value of energy resources. This creates preconditions for its steady rally. In addition, a correction in the foreign exchange market will most likely bring the dollar back to the range of 70 to 71 rubles. And that's all for now. We wish you profitable deals. See you in our channel with a new video in a couple of hours.